Hi, I'm Dr. Cheryl Dunn, and this video is to demonstrate how to make closing entries from a company's adjusted trial balance that they have at the end of an accounting period. So take a look at the company's account balances that were given. You can see that I've copied some of those balances here onto a mini general ledger in T-account format. I've only copied the accounts that we actually need to use in this exercise. Notice that the balances for the asset accounts like cash and accounts receivable and inventory, and the accounts for liabilities like accounts payable, those are permanent accounts. Same thing with contributed capital accounts such as capital stock, or in this case common stock. Those are permanent accounts. They're a part of the balance sheet, and their balance continually gets updated, and we don't close them out. They never turn into zero unless the business transactions happen to make them become zero once in a while. But we don't purposely close their balances out because they're at a point in time. Whereas accounts like revenues, sales revenue, interest revenue, and our expenses such as cost of goods sold, salaries expense, advertising expense, insurance expense, interest expense, supplies expense, and utilities expense, those are temporary accounts. They cover a time period, so they have a beginning and an ending time, and they're capturing what happened between those dates and including those dates. And so that means when we get done with those dates, we need to zero them out to start the next time period. Dividends is another one of these temporary accounts. So revenues, expenses, and dividends are our temporary accounts. So we're going to look at how we actually close those out, and how we close those out is we transfer their balances to the retained earnings. The retained earnings, you'll notice, is the one real account that's on our mini general ledger here. And that's because the balance of retained earnings only gets updated during the closing process typically. The reason retained earnings only gets updated during the closing process is because instead of taking transactions to retained earnings that affect it, we have instead created these temporary accounts to hold the transactions that really are affecting retained earnings. So we created the revenue accounts and the expense accounts and the dividend accounts in order to track the activities for a period of time. And instead of putting those amounts into retained earnings, either as increases or decreases, we put them into these temporary accounts instead. Once we get to the end of that time period, then we have to transfer those balances from those temporary accounts into the permanent account called retained earnings. And we call that process of transferring the balances, we call that making closing entries. We make closing entries in a general journal, and so you can see I've created a general journal here, a blank one, for us to make our journal entries on. And so we're going to proceed with taking these temporary accounts and closing them. Our first entry, and we are on December 31st here, for DabneyBard Inc. And the first entry we're going to make is going to be to close the revenue accounts. Okay, so look at our revenue accounts. We have sales revenue and interest revenue. And notice that they each have credit balances, because when we record revenues to increase the revenues, we credit them. We need to close these out, which means we need to debit each of these revenue accounts. And then what account gets credited depends on whether the company uses an account called income summary in its closing process. Some companies use this to basically calculate the net income for the period. Other companies skip the income summary and close these directly to retained earnings. We're going to show the process using the income summary here, and then I'll discuss what it would have looked like if we had skipped the income summary and went directly to retained earnings as well. So our first entry is to debit sales revenue for its balance of $381,316, and to debit interest revenue for its balance of $12,128, and we're going to credit the income summary for the total of these two numbers, which is $393,444. If our company didn't use an income summary, we would have simply credited retained earnings here, and then retained earnings would end up being increased for the revenues. Our second closing entry is to close our expense accounts. And so we look at our expense accounts and notice that each of these expense accounts has debit balances. To close those then, we need to credit the expense accounts, and we're going to debit that income summary. And so we again put in our date, since this is a new journal entry, and we're going to debit the income summary. I'm going to leave the amount blank for the moment so that it will be easy to see what I'm adding up to get to that amount at the end. But I wanted to go ahead and write the debit part of the entry first, so I went ahead and put the account in there. Now I credit each of the expense accounts. So cost of goods sold is going to be credited for $198,931. Salaries expense is going to be credited for $102,319. Advertising expense will be credited for $24,125. Insurance expense will be credited for $14,875. Interest expense will be credited for $5,194. Supplies expense will be credited for $5,930. And utilities expense will be credited for $18,095. So those are our 7 credits to our 7 expense accounts. The next thing I need to do is add these together to get the total amount that I'm going to debit to the income summary. And that number ends up being $369,469. Okay, so that's our first 2 closing entries. The first to close the revenue accounts, the second to close the expense accounts. If we had not been using an income summary for this company, we would have debited retained earnings instead of debiting the income summary. To see the role that the income summary is playing, I want to go ahead and post these first 2 closing entries into our general ledger so that you can see what's happening in the income summary, because our third entry is going to be to close the income summary into retained earnings. So let's take a look. We're debiting the sales revenue for $381,316. To post that journal entry, we basically transfer it over to here, and so we debit sales revenue for $381,316, which then gives us a 0 balance in sales revenue. We then debit the interest revenue for $12,128, and that gives us a 0 balance in the interest revenue. We then credit the income summary for $393,444, and that gives us a balance in the income summary of $393,444. Then we post the second entry, and that means we're going to debit the income summary for $369,469. And if we then compute the balance in the income summary, that's going to give us a credit balance of $23,975. This number, this 23,975, basically equals our net income for this time period. If we didn't use the income summary, these two entries would have both been made directly to retained earnings, and we wouldn't have the net income handily calculated for us here. Not a big deal. We can still calculate it on a separate piece of paper, on our income statement, somewhere else, but the companies that use the income summary use it because it gives them a nice handy place to compute the net income for the company. We also credit all these expense accounts, so we're going to credit the cost of goods sold, which is going to zero that out. We credit the salaries expense, which zeroes that out. We credit the advertising expense, which zeroes that out. We credit the insurance expense, which zeroes that out. We credit the interest expense, which zeroes that out. We credit the supplies expense, which zeroes that out. And we credit the utilities expense, which zeroes that out. So now our first two entries, and we're just going to put check marks since we don't have any account numbers to write in here. That indicates that we have posted all of the lines of these two entries into our general ledger. Our third closing entry is going to take this income summary, which is just a purely temporary account. It's even more temporary than revenues, expenses, and dividends, because the only time income summary will have balance is during the closing process. It zeroes out once we're closed, and then it doesn't have any activity again until the end of the next accounting period when we do closing entries again. So currently it has a balance of $23,975. We need to zero it back out again, so that means we're going to debit the, I'm going to make it over here in the journal entries, and then we'll post it to the ledger. So we're going to debit the income summary. And we're going to credit retained earnings, which is where we would have posted those other entries if we didn't use an income summary. So we're taking the effect of those revenues and expenses ultimately to the retained earnings account where they belong. The net income total was $23,975, so that's the amount of our journal entry. Notice that when we post this entry, so we take it from the general journal into the general ledger, so now we debit the income summary, that has now zeroed that out, and instead we have credited retained earnings for that amount. So that's our third closing entry. Our fourth closing entry is to close the dividends account into retained earnings. Notice that the dividends account currently has a debit balance of $6,000. That means we need to credit the dividends account for $6,000. And that means that the retained earnings account then is going to be our debit part of that entry. So we're going to debit retained earnings for $6,000. And we're going to credit dividends for $6,000. I forgot to check mark that I had posted those two. Next, we're going to post our final closing entry. So we're going to debit the retained earnings for $6,000. And that's going to give us a balance in our retained earnings account. We take the beginning retained earnings plus the net income minus the dividends to get the ending retained earnings balance. Hopefully you've seen that equation before. That makes up our statement of retained earnings. And having that equation handy in there is another reason why a lot of companies like to use that income summary, because rather than posting the revenues and expenses separately to retained earnings, we have the net income number going into retained earnings, which is part of that equation that we use. That amount is, if we start by adding up the credits on the one side, and then we subtract the 6,000, that's going to give us 94,399. That's our ending balance in retained earnings. So once we've closed our net income and subtracted our dividends, we end up with $94,399. The dividends then gets credited for $6,000, and that leaves us with a zero balance there, and we can check mark each of these to note that we posted those entries. Hopefully by seeing this retained earnings account, seeing the amounts get posted to it, you'll understand what this closing process is doing. And seeing all these zeros, we're basically taking all of these accounts that have a time period behind them, we're zeroing them out to start the next time period. Once these balances are zero, all of the balances, all of that activity for that time period has now been transferred into the retained earnings. And notice everything affected retained earnings the way we thought it should. The net income increased the retained earnings, the dividends decreased the retained earnings, and we ended up with that equation behind retained earnings that we know and love. The income summary started out at zero, had no balance at all. We increased it for the revenues, we decreased it for the expenses. That gave us that net income amount. We then transferred that net income amount to the retained earnings. Thank you for viewing this demonstration, and I hope you found it helpful.